In recent years, central bank digital currencies, CBDCs, have become a major topic of discussion among financial policymakers, economists, and technologists. As the world shifts towards digital financial infrastructure, central banks are exploring CBDCs as a way to modernize payments and monetary systems. One of the key areas where CBDCs have the potential to revolutionize the financial landscape is in cross-border payments. The current system of cross-border payments is notoriously slow, expensive, and complex. CBDCs could address many of these inefficiencies and create a more streamlined, efficient, and accessible global payments network. In this article, we will explore what CBDCs are, why they matter, and how they could transform cross-border payments. We will also examine some of the challenges and considerations associated with CBDC implementation, including regulatory frameworks, interoperability, and the potential effects on financial stability. What are central bank digital currencies, CBDCs? A central bank digital currency, CBDC, is a digital form of a country's sovereign currency issued and regulated by its central bank. Unlike cryptocurrencies such as Bitcoin or Ethereum, which are decentralized and not controlled by any single entity, CBDCs are centralized and fully backed by the state. In essence, a CBDC is a digital version of fiat currency, the US dollar or the euro, that can be used for payments, savings, and other financial transactions. There are two primary types of CBDCs that are being discussed and tested globally. Retail CBDCs. These are designed for general public use. Individuals and businesses would be able to hold and transact in a digital form of the national currency directly with the central bank, similar to how they hold physical cash today. Retail CBDCs would function like digital cash, allowing users to make payments, store value, and transfer money. Wholesale CBDCs. These are primarily designed for use by financial institutions and banks. Wholesale CBDCs could improve the efficiency and security of interbank payments and settlement processes, reducing the need for intermediaries like clearinghouses and reducing risks in the financial system. The current challenges of cross-border payments. Cross-border payments, which refer to financial transactions where the sender and receiver are located in different countries, are a crucial part of the global economy. They facilitate international trade, remittances, and investments, among other activities. However, the current system of cross-border payments is fraught with inefficiencies, high costs, and long delays. Here are some of the key challenges with the existing system. High costs. Cross-border payments often involve multiple intermediaries, such as correspondent banks, each of which charges a fee. As a result, cross-border transactions can be expensive, especially for smaller amounts, such as remittances sent by migrant workers. The World Bank estimates that the average cost of sending remittances globally is around 6.3%, which is far higher than domestic payment costs. Slow processing times. Cross-border payments can take several days to settle, especially when multiple currencies and jurisdictions are involved. The reliance on traditional banking infrastructure and correspondent networks can cause significant delays, which is particularly problematic for time-sensitive transactions like trade payments. Lack of transparency. It can be difficult for users to track cross-border payments, as they often pass through several intermediaries. This lack of transparency can lead to confusion and uncertainty, especially when payments are delayed or encounter issues. Currency exchange risks. Cross-border payments frequently involve exchanging one currency for another, which exposes both parties to exchange rate fluctuations. This adds complexity and risk to international transactions. Regulatory compliance. Cross-border payments must comply with various regulatory requirements, including anti-money laundering, AML, and Know Your Customer, KYC, regulations, as well as capital controls imposed by different jurisdictions. This can make cross-border transactions cumbersome and time-consuming. How CBDCs can transform cross-border payments. CBDCs have the potential to address many of the inefficiencies and challenges associated with cross-border payments. By leveraging digital technology, CBDCs could create a more efficient, secure, and cost-effective system for sending money across borders. Here's how. Lower costs and fees. One of the most significant potential benefits of CBDCs for cross-border payments is the reduction in transaction costs. CBDCs could eliminate the need for multiple intermediaries, such as correspondent banks, by allowing central banks to directly interact with one another in real time. This could significantly lower the fees associated with cross-border transactions. For example, if two countries implement CBDCs that are interoperable, central banks could facilitate direct transfers between their respective digital currencies. This would reduce the number of steps in the process, cutting down on fees and making cross-border payments more affordable, especially for individuals and small businesses. Faster settlement times. CBDCs could enable near-instant settlement of cross-border payments. The current system often relies on correspondent banking networks, which can take several days to process transactions. With CBDCs, central banks could settle transactions directly in real time, reducing the time it takes for cross-border payments to be completed. This faster settlement process could be especially beneficial for businesses that rely on international trade, as it would reduce the time they have to wait for payments to clear, improving cash flow and reducing the risk of payment delays. Improved transparency and traceability. CBDCs could enhance the transparency and traceability of cross-border payments. Because CBDCs are digital and built on blockchain or other distributed ledger technologies, DLT, each transaction can be recorded and tracked in real time. This would make it easier for individuals and businesses to monitor the status of their payments and ensure that funds are delivered to the correct recipient. This increased transparency could also improve regulatory compliance, as it would be easier for authorities to track and prevent illicit activities, such as money laundering and terrorist financing. The real-time traceability of CBDCs could make it easier to identify and block suspicious transactions. Reduced currency exchange risks. In a future where CBDCs are widely adopted, central banks could develop mechanisms to facilitate direct currency exchanges between different CBDCs. This would reduce the need for intermediaries and help mitigate currency exchange risks associated with cross-border payments. For instance, if a business in the US needs to pay a supplier in China, the US CBDC could be directly exchanged for the Chinese CBDC at a pre-agreed exchange rate. This would eliminate the need for businesses to rely on traditional foreign exchange markets and reduce their exposure to currency volatility. Enhanced regulatory compliance. CBDCs could streamline regulatory compliance in cross-border payments. Today, international transactions must comply with a variety of regulations, including anti-money laundering, AML, and Know Your Customer, KYC, rules. The current system requires financial institutions to perform these checks at multiple stages of the transaction process, which can be time-consuming and costly. With CBDCs, central banks could build regulatory compliance directly into the payment system. By using programmable features, CBDCs could automatically verify the identities of both parties in a transaction, ensure compliance with AML and KYC regulations, and provide a secure and transparent audit trail. This could reduce the administrative burden on businesses and financial institutions while improving the overall security of cross-border payments. Potential challenges and risks of CBDCs in cross-border payments. While CBDCs offer many potential benefits for cross-border payments, there are also several challenges and risks that need to be addressed before they can be widely adopted. Some of these include interoperability between CBDCs. One of the biggest challenges for CBDCs in cross-border payments is ensuring interoperability between different digital currencies. Each country's CBDC will likely be designed with its own regulatory and technical standards, making it difficult to create a seamless global payment system. For CBDCs to work effectively in cross-border transactions, central banks will need to collaborate on developing common standards and protocols for interoperability. Without this coordination, there is a risk that the fragmentation of CBDCs could create additional complexities in the global financial system, rather than solving them. Regulatory and legal challenges. CBDCs will need to comply with various regulatory and legal frameworks, both domestically and internationally. Countries have different approaches to monetary policy, capital controls, and financial regulation, which could complicate the implementation of CBDCs for cross-border payments. For example, some countries may impose restrictions on the use of their CBDCs in foreign jurisdictions or implement capital controls that limit the amount of money that can be transferred across borders. These legal and regulatory barriers could hinder the seamless flow of CBDCs in the global economy. Cybersecurity risks. As with any digital system, CBDCs will be vulnerable to cybersecurity risks. Cross-border payments, in particular, could be targeted by hackers and other malicious actors looking to exploit vulnerabilities in the system. Central banks will need to invest heavily in robust cybersecurity measures to protect CBDCs from potential attacks. This includes implementing strong encryption protocols, securing the infrastructure that supports CBDC transactions, and developing contingency plans in case of a cyber attack.